Coming up, I speak with the CEO of Xero about the so-called SaaSpocalypse and what's happening with AI in the future. Plus, BHP and Rio Tinto hit a record high. All of that and more market news next. Hi everyone, welcome to the SBS on the Money podcast for this Thursday, the 14th of May 2026, a day where the Australian share market rose, but only just. The S&P ASX 200 up 0.1%. We'll have the details with Hugh Lamb from Beta Shares in a few moments. But first, the CEO of cloud accounting group Xero is looking beyond investor fears of a so-called SaaSpocalypse. Following concerns AI could limit its relevance, its share price is down more than 50% over the past year. Today, it posted a 27% fall in net profit to just over 167 million New Zealand dollars and rising revenue following costs relating to a US business acquisition. So what's the future of its business amid an AI revolution, and what does it mean for the broader economy? I spoke with Xero CEO Sukhinder Singh Cassidy to find out. Sukhinder, can we start with the so-called SaaSpocalypse, right, in a broader sense? That's this sell-off across the sector due to fears AI will replace traditional seat-based software. Xero's obviously been caught up in this, shares down 55% in the past year. Are investors overreacting?
Well, look, first of all, the thing I always want to remind people of, we are builders of software. We love AI. AI is one of the biggest technology innovations that we've seen. And like cloud before it, which led to the birth of Xero, or mobile, AI is going to create brand new TAM and opportunities, and we believe we are participants in that. So I think we look at AI as a net tailwind, not a headwind to our business.
Yeah, that's interesting. In your release today, you say that Xero is well positioned to be a long-term AI winner. So can you run through how? How are you integrating it to your service? And are you seeing any cost benefits right now from any investments?
Got it. So great questions. Well, first of all, if you think about Xero, we have multiple investments and layers of value we offer to customers. Let me start. We think of ourselves as like a trusted operating system for small businesses. At the very bottom of that is trusted infrastructure. We are connected to banks. We're connected to tax offices. With the acquisition of Melio, we're connected to payment rails. We're licensed. We're regulated. That makes us a very trusted infrastructure provider. On top of that, of course, we have 20 years of collecting and processing data on behalf of small businesses. So that gives us proprietary data models that we can wrap around many of the AI models you might know, an OpenAI or an Anthropic, in order to provide that third layer of value, which is really winning workflows. And what used to be, workflows where, maybe Xero assisted you with the job are now quickly becoming workflows where Xero does the job for you. A big example is auto bank reconciliation. I mean, that is the core of our platform. We're bookkeepers, right? At the end of the day, it's a bookkeeping platform, and it serves 5 million small businesses and 250,000 accountants. But now you can go from sort of having to do the job with help from our software to the software just auto reconciles your books. I mean, that is hours back that you can spend on your business. And then, of course, the last layer of value we provide is like we are a multi-channel global business that acquires small businesses at large scale, not only through traditional channels, but also increasingly through distribution with the LLMs. In fact, we announced and made live a deal with Claude, where you can now query Claude and get answers on your Xero financial system, all in a trusted setting. So I think we look at all those layers of value, and the opportunity each of those layers is for us to add AI strength and to position ourselves to provide even more value for small businesses.
When I spoke to a few analysts and I told them I was speaking with you, they told me that basically the one question that they wanted answered was what kind of competition you're seeing right now from new cheap AI services and how you're managing that.
Got it. Well, I will note that this year we added 516,000 subscribers. It was one of the strongest years of subscriber growth we've had at Xero. And I think what we would say is we continue to be a trusted, very accessible price point, full stack solution that does accounting, payments, payroll, and AI on top of all of it. And that allows us to acquire customers very efficiently, including versus native startups.
Okay. On AI and the economy more broadly, do you see it, or to what extent do you see it solving productivity issues? I mean, we know that Australia has a productivity problem. The federal budget emphasised productivity reform. And what does it mean for the future of work, given all these fears it may prompt changes in the workforce?
Yeah, so first of all, do I think it's a net productivity enhancer? Absolutely. Think about the examples I shared. Like, we live in the world of small businesses. Our job is to make them more productive, not only more productive, more intelligent, and make sure they're able to not just survive with cash flow, but thrive, right? AI helps with all of that. It gives them better intelligence. It takes away the work even of software like Xero. I mean, Xero was considered magical before AI. Imagine with AI, the jobs we can do on your behalf. That's giving you back time on what we call administrative tasks to go channel back into your business or whatever it is that powers your economic engine. If you're a retailer, it might be when your store is open. It might be able to have enough cash flow to hire that next, person in your store to keep your hours open. So these are all ways we can give back time, and time equals money for most small businesses.
And what about the fears of the change in the workforce? I mean, in other words, will AI take jobs?
I think that there is a history to technology that has been played out again and again and again. First and foremost, technology disruption typically drives larger TAM. When we say larger TAM, because new use cases become possible that you never thought were possible. So an example I give is one of my first jobs was at Google. And at that time, Google was basically saying, hey, you know what? There's this industry called the Yellow Pages that sells local advertising, but online, there's not really a good way to search locally for businesses. So we built Google Local and Google Maps. Now, today, the size of local advertising is multiple times the size of the original local advertising market, right? 25 years later, it expanded the pie. That doesn't mean that there weren't changes within that pie. Does that make sense? So I would say my advice to everybody here is, as AI expands the pie, whether you're an individual, whether you're a company, you want to be a user of the tool. So you participate in that economic expansion versus avoiding using the tools.
On the economic outlook, we know from various reports like the NAB Business Survey that sentiment is soft and conditions are now below long-run averages. What are small businesses telling you about the way they're feeling, and what does it say about the economy, specifically in Australia?
Yes, we run what's called XSBI, which is Xero Small Business Insight across all of our markets, including Australia, New Zealand, the US, the UK, and we have specific insights to each market. Interestingly, XSBI in the most recent quarter for Australia and New Zealand shows that actually there is sales growth recovery. That doesn't, let's separate sentiment from resilience and recovery. So we're actually seeing increasing growth, believe it or not, in sales in real terms over the past quarter versus this time last year. Having said that, I think we can agree across the world, including in ANZ, it is a time of unprecedented volatility and uncertainty. And we see that also in our data, if that makes sense. And so it can be both true that you are resilient, that on the face of it, sales are increasing, and yet you feel like it's an uncertain and volatile environment. We feel like our job at Xero is to be your partner when times are good and when times are uncertain. The one thing we wanted to help small businesses do is run their businesses more successfully and profitably and help them manage that cash, even through times of uncertainty.
Final question on the business. You've got big US ambitions. Is that where the growth is for Xero?
Well, the good news for us is growth is global for us. So Australia, which is one of our most mature markets, grew 20%. We had the UK, also a very big market for us, grew 26%. Our rest of world markets, which is a very efficient, engine for us, where we support almost 180 countries, grew 21%, and the US grew 30%. So while it's true that our US growth is stronger, and that's organic growth because we've also, of course, acquired Melio, I would note that all of our big regions grew, including Australia and New Zealand.
That is Xero CEO Sukhinder Singh Cassidy there speaking with me earlier. Now to the Australian share market, which rose. It did trade in the red for most of the day until the very end of the session. The 200 up 0.1%. BHP hit a record high for a third day in a row. Rio also hit a record, and CBA rebounded 1.8% following yesterday's record 10.4% loss. Coles lost 2.2% after the ACCC won a landmark federal court against it, finding it had misled shoppers over discount pricing in-store promotions conditions. But for more on the day's market action, I spoke with Hugh Lamb. He's an investment strategist at Beta Shares. Hugh, the market's relatively flat today, post-federal budget and a meeting between the leaders of the US and China. How are investors feeling at the moment?
Yeah, it's a good question, Ricardo, and thanks for having me on. I think just to give a bit of context, we finished the month of April, which was a stellar month for global equity markets. We saw a rally in major indices, really off the back of the announcement of a ceasefire, and markets were looking forward to a resolution. Q1 2026 earnings in the US were also much better than expected, led by the major US tech companies. So all in all, optimism and the mood was actually quite jovial and optimistic throughout the month of April and heading into May. Although I think we're at pretty significant crossroads. President Trump is in China right now to meet Xi. There are a lot of things on the table right now that have to be discussed, including, of course, where trade is going to go from here. The issue around Taiwan remains a key risk for both the US and China, but also the broader world too. AI and, of course, energy security too. Look, it's probably unlikely that we're going to see a deal reached given the amount of structural differences between the two countries, but we'll probably see things like, tariff concessions being made, pauses, agricultural purchases in some areas of the market, and also rare earth exports might be sectors where the two sides might negotiate. I think all in all, though, I think that, as I mentioned, we're at a pretty important inflection point, and the mood seems a little bit more wait and see right now.
We also had the federal budget earlier this week. Do you think the changes in tax rules will have any impact on the way people invest in the share market?
Yeah, so it's been one of the most consequential federal budgets that we've had in many years. Of course, we've had major reforms to both capital gains tax from 50% to a pre-1999 indexation model, and also major changes to negative gearing. I think that, across the board, we are going to see Australians pay more and more taxes. In terms of, how that affects where they invest in the share market, look, you might see some, changes within a person's asset allocation mix, or the mix between stocks and bonds. You might see some movements there. But I think, more broadly, the structural themes that have led to the popularity and rise of vehicles like an ETF still remain here. House prices in Australia remain extremely high across developed markets, and the issue of young people or young Australians trying to enter the house market still remains a key issue. And so the likes of ETFs will remain an important vehicle and access point for those type of people to build up a deposit, build wealth in order to save up a deposit for a house. So I think that, yes, whilst the federal budget is going to have major tax consequences for many Australians, the appeal for something like an ETF wrapper still remains there, because it's one of the most simplistic, greatest ways to build wealth over time in order to tackle our housing issue.
Okay, speaking of housing, there's housing loans. So let's talk about the banks. Shares in the Commonwealth Bank up just a little bit today. The company was walloped on the share market yesterday. I think it had its worst one-day loss on record, down 10.5%. What does this say about the banking sector and the challenges ahead? Because this came after the federal budget, but also after its profit result too, where it put some more money away in case of bad debts.
Yeah, so the 10.5% fall was the worst daily fall for CBA since its history when it listed in 1991. So about $30 billion of market cap was lost in a single trading day. And, there were a few things that happened that led to that fall. If we think about, the amount of loan impairment expenses that they reported, that's nearly doubled compared to their the previous quarter averages. The amount of personal loan arrears over 90 days that hit 1.7%, and that's the highest rate since COVID. But of course, the impact of the federal budget, is going to have pretty major consequences for CBA's investor loan book. They have over $211 billion in investor loans, and the changes to negative gearing and capital gains tax is going to put some downward pressure on the margins and loan book growth for that investor portfolio. So There were a few sort of pieces within their latest trading update that we saw yesterday that led to that decline. I think what it tells us about the broader banking sector is that, generally there's, a lot of the management teams of these banks are pointing towards a more challenging environment. We have seen increased provisions being written. Generally, they have noted a lower economic growth environment, and as we know, that's going to be, at the margin, not as good for the amount of loans that you can grow. And also high interest rates. While higher interest rates can be good for, what we call their profitability or their net interest margins, that's going to raise a lot of competition for the deposit books. So, all in all, it's a very challenging environment for the banks, and they had started at very high starting valuations. And so we have seen some steam coming off. That said, though, it is important to realize, the banks still remain relatively well funded and well capitalized. But if there's anything in terms of similarity across their results and updates, it's one that's speaking of caution and a more challenging environment going forward.
CBA is just one of a few big names to see their share price be really hit over the past few months. I mean, you've got the likes of Cochlear, CSL. Yep. I mean, CSL used to be Australia's largest listed company 4 or 5 years ago. Now it's not even in the top 10, right? What do you think this is a sign of?
Yeah, we've seen some pretty big movements to the downside for both Cochlear and CSL. I mean, just on CSL, recently they reported a pretty big write-off in their Vifor kidney transplant unit. So $5 billion was written off, and that's the largest in ASX corporate history. In addition to falling plasma demand which is their core business, that really has affected CSL, and I think their share price is down about 50% over the last year. Again, Cochlear with their hearing implants as well, we've seen falling profit guidance from them that has led to pretty remarkable share price declines. I think what all of this is telling us, the share price falls in both Cochlear, CSL, CBA. So really speaking to the market repricing what we think about quality and blue chip stocks within Australia. If we think about these companies have been heralded as quality, very strong businesses with very defensible moats. And to your point, Ricardo, some of these businesses, CSL were quite large in the index, and so we have seen a massive repricing in the definition of what it means to be quality, what it means to be defensive. And that leads to my second point in that investors are looking elsewhere now. We're seeing capital rotate into other sectors of the market, particularly in materials and resources, that has really benefited off this increased environment of heightened geopolitical tension. We've seen our miners like BHP and Rio outperform. So yeah, we've seen a massive repricing in what it means to be quality, and capital is flying elsewhere.
That's Hugh Lamb from BetaShares. I also asked him about the future of AI following my interview with the CEO of Xero, Sukhinder Singh Cassidy.
Look, the AI ecosystem is quite broad. I think when people think about and say quite negative things about it, we have to look underneath the surface. And why I say that is because we've actually seen quite a large bifurcation in returns among subsectors of technology. So what I mean by that is, companies tied to the hardware AI infrastructure, the companies that are actually building the chips, the data centers, they've actually performed very, very well. In particular, we're talking about, countries like Korea. Their share market has absolutely exploded, driven by memory chip providers like Samsung and SK Hynix. In fact, South Korea's economy is actually bigger than the likes of Canada. So it really speaks to where the market is heading. It's really gravitating to those AI hardware beneficiaries. But to your point, Ricardo, SaaSpocalypse, that has been a major theme for investors since the back end of 2025. The idea that, with all these AI codes, agents, I can just build my own software. And what is the point of investing in something like a Salesforce or Adobe, right? I think that, generally our view is AI is going to be, a strong tailwind for the tech sector more broadly. Although within the software sector, we will definitely see winners and losers. I think in terms of the losers, companies that don't have, very unique data sets, proprietary moats, very low switching costs, you'll see them really continue to struggle. But in terms of winners, I think a lot of companies, particularly within the cybersecurity industry, will benefit because they can use that very same AI technology, for example, Claude Mythos, within their business models to improve their core offerings. And again, they have very unique data sets that they have signed up and gathered across enterprises and businesses around the world. So you will see some bifurcation within software, of course. I think hardware and tech infrastructure will remain key winners. But more broadly, I think that if anything, we've learned from the internet boom that yes, whilst there is an initial CapEx cycle that needs to occur, eventually productivity does follow through. And that is sort of our core view if we think medium to longer term.
And finally, in wrapping up, what are you telling your clients right now, and where do you see the opportunities for investors?
Yeah, so in terms of what we're telling our clients and where we see markets, look, we've seen quite large moves in terms of sector performance. I've talked about that bifurcation happening within the Australian market away from those traditional qualities blue chip stocks to the likes of the banks, the miners and material sectors. Within the global sort of stock market, we've seen rotations again towards AI, tech, hardware, etc., as we've talked about. I think that it is important to stay invested, remain diversified in an environment that's continuing to reward different winners and losers. And again, a access vehicle, whether that's an ETF, provides that diversified exposure across different industries. You can still be invested in the structural growth trends that the global economy is heading towards, whilst avoiding some of the key losses in certain sectors. So I think staying calm, staying invested, staying diversified remain key points for our investors.
That's Hugh Lamb there, investment strategist at BetaShares, and he wraps up the podcast for this Thursday. Don't forget to give it a like, a review, and subscribe if you enjoy it. And remember to watch On the Money during the 6:30 weekday edition of SBS World News on SBS. The podcast returns tomorrow. It drops after the market close every weekday, and I'll catch you then. This SBS On the Money podcast is provided for informational purposes only and should not be understood as constituting advice or a recommendation. It is not personal advice, and it does not consider your personal circumstances or objectives. You should contact a licensed professional before making any financial decisions.